I would like to welcome everyone to this inaugural summit on short-termism. So that's a kind of abstract kind of concept, but hopefully after this event we know more about it. This event is co-created with the students of the honors program. So tomorrow they will present their work and there will be further discussions about this. But the first part of our event is a keynote by Professor Stuart Hart. He is the professor in residence at the University of Michigan's Erb Institute for Global Sustainable Enterprise, and is also the founder of the Enterprise for a Sustainable World, a nonprofit dedicated to helping businesses make the transition to sustainability. He has published many papers, more than 70 papers, has written 7 books, and his article, Beyond Greening, Strategies for a Sustainable World, won the McKinsey Award for Best Article in the Harvard Business Review in 1997. So it's a pleasure to welcome Professor Hart.
Wonderful, Marcel, thank you. Great to be with you guys, huh? So I guess my role is to sort of start the party, sort of set the stage. And so what I'd like to do is I'll sort of leverage off, this is my new book, by the way, not to market too much here, but you can see that it's consistent with the topic. And so I'll draw from it, but what I want to do is raise some questions, maybe be somewhat provocative, but then also perhaps provide some context, some larger sort of backgrounding on this notion of short-termism and where might it fit into the larger scheme of things. And then maybe illustrate through a few specific case examples, kind of the impact and implications of this, all to the point or to the end of, turbocharging the panel discussion that we'll have after my talk. So that's the agenda. Does it make sense? Good. So I'll start with some questions. And we were talking a little bit, kind of the group back in the green room before we came out here about this term, short-termism. Because, let's face it, it's a buzzword, right? I mean, it's a buzzword like so many buzzwords. It's like strategy or sustainability, right? It can mean so many different things. But it's a hell of a buzzword, and I think it's good at sort of raising questions and, provoking discussion about what do we think this really means. So, first off, what constitutes short-termism? What is it a time, strictly a time? Does it mean monthly, or does it mean quarterly or annual, 3 to 5 years? Does it matter in terms of what types of practices? There are 10-year sustainability goals. Is that long-term? What is vision and mission? How does that fit into the idea of short-termism? I mean, I think it raises all kinds of questions, all the way out to are we short-term unless we focus on 7 generations? So the question of time frame, I think, is an important one for us to consider, and I'm sure we'll explore that further in the panel. I mean, is this just a matter of discount rates, or is it something much more significant? Is short-termism a problem if it makes shareholders wealthier? Right? I mean, right? I mean, hey, if people do well as a result of short-termism, what are we complaining about? But does it matter which stakeholders benefit? If it's just the activists, or if it's the hedge fund guys that make all the money, is that okay? Or do we care, about which other? Not all the shareholders are the same, right? So maybe we should be concerned think about that. I have a sneaking suspicion that I know who made a lot of money in the last few days, and it probably wasn't the general public. Who are the main actors responsible for short-termism, right? Is it all on corporate management? Is it just these sort of narrow-minded, compensation-tied senior executives? Or boards? Is it the analysts? Is it Wall Street that's responsible for it? Is it the shareholders themselves, like we're saying, the activists and so forth that kind of bring this pressure? What role do business schools play? Right, in training people to go out into the world to be analysts, right, or to be consultants. It seems to me that these are all important questions for us to consider. And then finally, is short-termism, is it a cause? Is it a result? Or is it a symptom of something larger? Like, for example, shareholder primacy, right, as a larger system of capitalism, and you can tell where I'm going with this, right? You can tell where I'm going. What I want to suggest is I think short-termism is embedded in a larger system of capitalism, at least the form of capitalism that we've been committing over the last 30 or 40 years. And let me draw a little, I'll give a version of my take on what that looks like, kind of a systems map of shareholder primacy, because I think shareholder primacy is a system that drives short-termism, but a lot more as well. And we'll start with the kind of the prime directive of shareholder primacy, which obviously enough is to maximize shareholder value, right, as the prime directive. Nothing inherently wrong with that, right? I think it depends entirely on what is it that drives shareholder value and over what time frame, right? So that by itself, I think we need to fill that out a little bit and give it much more flesh on the bones in order for it to make any sense. Well, I think it's fair to say that the current version of capitalism, I call it shareholder primacy capitalism, is really sort of rose to the fore, starting in the 80s in particular, right? With often attributed to our friend Milton Friedman. But there's much more to it than that, right? I mean, the urgings around economic freedom go back to the 20s and 30s, the National Association of Manufacturers. It was Friedrich Hayek and Ludwig von Mises in the post-war years, coming from Europe to the University of Chicago and NYU. But it was Friedman and the Chicago economists that really got traction with these ideas, starting in the 70s and then on into the 80s when they really took off. And there were some other foundational kind of pillars that supported and defined this idea of shareholder primacy, like quarterly earnings growth is the main driver of the stock price, which sort of comes from ideas around market fundamentalism, comes from the ideas that markets know all, that all information is in markets, efficient markets. Now, a lot of that's been since discredited, but I think it still affects the thinking, right? It's still part and parcel of this notion of shareholder primacy and short-termism. And then on the other side of it, if executives are assumed to be self-interested, kind of greedy people that aren't going to work for the shareholder, then we got to hold them accountable and tie their comp to share price. And that was kind of agency theory, right? So we have some academic theories that have been influential in creating kind of this system of maximizing shareholder value that's driven more by quarterly earnings and tying exec comp to stock price. So now, associated with this sort of central three-legged stool that I just defined or just described, there are a set of other kind of associated behaviors that I think have gone along with this over the last 30 or 40 years. Like, for example, this is sort of a corporate set of behaviors, but it's also embedded in a political system, a political order as well, which has been what we would call neoliberal, right? For the last 30, 40 years, that's under fire. We're not living in that world anymore. But over the last, beginning in the 80s, it often meant lobbying for deregulation, privatization, globalization, right? That was the era of globalization, starting in the 80s into the 90s and so forth. That was what would really drive growth, right? That's the more that you can privatize, create more markets in more parts of the world is the growth driver, and so it makes implicit sense that this is what company leadership would lobby for. And if they want that growth to be profitable in the short term, then it's necessary to drive down expenses as much as possible wherever you can extract raw materials, at a less than market price. You would do that, preferably extracting them for free wherever you might be able to do it. Outsourcing and offshoring, limiting worker pay, reducing R&D, squeezing suppliers. These have all been, kind of long-standing methods dating back to the 80s and 90s that have been part and parcel to this way of thinking, this way of managing that I'll call shareholder primacy and short-termism. Now, if quarterly earnings is going to be the driver of maximizing shareholder value, then you would want to direct more of those profits to dividends and share buybacks because that will goose the stock price in the short term, right? And we've certainly seen a huge uptick of that over the last several decades. I mean, it was basically frowned upon going back to the 80s. After the Great Depression, the SEC basically banned it. But then it was green-lighted again in the early 80s and has grown ever since to the point now where it's about $1 trillion a year in share buybacks, mostly to goose short-term stock price. So this practice, of course, is part and parcel to this system of kind of quarterly earnings-driven shareholder value maximization. But then if we think some of the societal consequences, it widens the wealth divide, this sort of behavior that 90% of the stocks are owned by the top 10%, right? I don't think that comes as a great surprise to any of us. And financial assets now are 5 to 6x GDP. Again, if we go back to, say, 1980, financial assets, GDP were almost equal, and financial assets have dramatically outpaced, the growth of GDP ever since, which is why people in the investor class have gotten so much more wealthy. It also widens the income divide. We've seen CEO comp go from about 35x to 350x, kind of directly attributed to executive comp, kind of agency theory-driven executive comp to stock price. And then lastly, it makes sense to externalize negative impacts wherever you might be able to do so. Carbon emissions, plastic waste, whatever it might be, the more you can offload those, right? Find, kind of havens where you can dump waste, the better off you are, the more profit you'll make in the short term. So I think this to me describes the overall system of shareholder primacy, and embedded in it is short-termism, right? A short-term perspective that ends up driving this kind of behavior. It doesn't have to be this way, So in my book, I've looked back over the last 400 years, and unsurprisingly, we find that capitalism has been practiced in very different ways over the last 400 years, let alone different parts of the world today, right? It's not all American-style shareholder primacy capitalism as I'm describing here. And even this is now beginning to shift, as we all know, we're living it, right? Because nothing lasts forever, right? So all of this is fungible. There's nothing permanent about this. There's nothing preordained about this. But this has been, I would submit, our reality for the last 40 years. And it's had consequences, right? Let's face it. Yes, the last 40 years, we've lifted billions of people out of extreme poverty in places like China and so forth. Got to note that, right? I think that has happened. But we also have a burning case of climate emergency on our hands. We have, active loss of biodiversity and a sixth extinction, and inequality at levels we haven't seen in a long time, everywhere in the world pretty much. And what I want to do is sort of illustrate this through at least one company story. I'll have a few others as well. Just sort of how these pressures and this notion of kind of short-termism and shareholder primacy, how does it work, from the standpoint of a given company? And I've chosen one of the darlings of the sustainability movement, Unilever, right? Everybody knows Unilever? Yes. Thank you, Andy. So let me just sort of narrate the story. Forgive me if this is all kind of common knowledge. Unilever's been around a long time, right? I mean, Unilever, goes back decades, centuries, into certainly the 19th century, and became known really as a corporation that was locally responsive, right? It was sort of like the poster child for running operations in individual companies that respected kind of cultural embeddedness and tastes, that were culturally aligned. Like I was doing it at the time that I'm describing Patrick Seskow here, when he took over in 2000. There was a lot of investment in India, right? I was doing a bunch of work with the company at that point in time, looking to serve rural India, right, in what we've called the base of the income pyramid. There was a lot of investment there. Most Indians in the early 2000s didn't know that Hindustan Lever was part of Unilever. They just thought it was Hindustan Lever. They thought it was an Indian company, right? Because that was the way it was. It was the poster child for a global company that was locally responsive. The pressures for globalization changed all that, right? There was large pressure to standardize products, to leverage competencies across markets. That was pressure for shareholder primacy, right? And Seskow kind of fell prey to that, tried to do it, didn't work very well, right? They had succumbed to this sort of shareholder primacy pressure. But the stock price by 2008 really hadn't budged. In a decade, there was this crisis. P&G passed them, huge crisis. He was out. In comes Paul Pullman, right, at this point in time, 2009. First outside CEO hired. Pullman comes in, he's saying he's going to reinvent Unilever, unlock the company's soul, never waste a crisis. It sounds familiar. Some of his first moves were, as you would expect, shake up management, reconstitute the board, and so forth, but I've highlighted the ones that I think are relevant to our topic today. Suspending quarterly earnings guidance, pretty gutsy move, right? Reinvesting in innovation product development for the long term, right? Articulating a hierarchy of stakeholders. What did he mean by that? He basically said, I guess you would call it shareholders' subsidiarity. He said our focus is on serving the customer first and foremost, and if we do that in a way that is good for the communities the customers live in and is sustainable in the environment, then the shareholders will get a fair return. That was the statement he made, and he was sticking to it, right? That was his perspective about the hierarchy of stakeholders, and he introduced this new Compass vision, which was to double the size of the business while simultaneously reducing environmental footprint and increasing positive social impact. All sounds good. Making sustainable living commonplace became the purpose and mission of the company. In 2010, they launched this strategy, the Sustainable Living Plan. Notably, it focused on what we call today Scope 3, right? It was before the concept of Scope 3 existed, back 15 years ago. But they were already measuring the life cycle impacts of all the products and all the brands, so they're already thinking about Scope 3. And it made it very clear to them at that point that, 95% plus of the impacts were upstream and downstream, not from company operations. So that if they were going to really get after things, they were going to have to form collaborations, and partnerships out there in the world to really address these things like deforestation and water depletion and so forth. And, Pullman pursued those, with great alacrity. You can't see it, but this was sort of their representation, kind of improving health and well-being, reducing environmental impact, and enhancing livelihoods, and they had metrics kind of hanging off all these things and so forth. What happened over the 10-year span, 2009 to 2019? Well, they did double their revenue over this period of time. They did cut their environmental impact in half, but for Scope 1 and 2, right, within the four walls. Scope 3 still remained fairly elusive despite their best efforts, and it caused, Pullman to become even more committed to this idea of larger system change. That what holds us back is that a given company, it's difficult when it's embedded in a system that itself is inherently unsustainable. Operating margins improved by 20%. Shareholder returns climbed almost 300% over this period of time. Unilever gained a global reputation for this, number 3 world's most in-demand employer. And, Pullman's resolve in this case was tested in 2017. He managed to fend off this hostile takeover bid from Kraft Heinz. Many say, at least in part because all of the various partnerships he had formed with NGOs and with other players around this idea of system change came to the company's defense, and ultimately Kraft Heinz backed off. Now he stepped down in 2019, main regret, given the state of the world, that Unilever's Sustainable Living Plan wasn't aggressive enough. So it sort of did he defy gravity? I mean, in some ways this almost sounds too good to be true, right, that this happened. Well, let's just tell the rest of the story. After Pullman, Alan Jope became the CEO. He's sort of Pullman's handpicked guy, in 2019. He doubled down again on the Sustainable Living Plan, new 15-year goals and so forth and targets. They had come up with this idea of sustainable living brands, that every brand in the company should have a social purpose, right? That the goal is 80% sustainable living brands, that they grow faster, they deliver more company growth. 7 of the top brands fit that description. They had some problem children brands, like Axe and so forth, that they were wondering whether they should Axe, but that's a separate topic. He committed to calling out, these brands that were not able to articulate a clear social purpose. And he said, now it's central to the company culture. There's no turning back, that the mantra was brands with purpose grow, companies with purpose last, and people with purpose thrive. All sounds good, right? And then came the pandemic. And then came the pushback. In the wake of that. You can't really see this chart very well, but all you need to see is the orange getting over the purple. That's P&G, right? And their stock price in the wake of in the wake of the pandemic, kind of exceeding that of Unilever's. And that's what Unilever stock did in 21, 22, 23 timeframe. So, they missed on an acquisition that probably would have propped up their short-term earnings in that time frame. That probably contributed to this downward pattern. The stock hit a 5-year low in 2022, at least partially as a result. Nelson Peltz, the activist from Trian Management, acquired a board seat in 2022. Unsurprisingly, Joe announced his intention to retire in the same time frame, and a new CEO, Heinz Schumacher, appointed CEO in July 2023, and he signaled a radical shift in Unilever's sustainability agenda, which was basically to take it back to sort of, we're going to do things that pay off in the nearer term. We'll continue to do things that will, kind of drop to the bottom line, things around waste reduction and so forth. That's all good stuff. But all this stuff about, kind of system change and collaboration out there with these, these communities around these bigger issues that, that make it more difficult to get to where we want to go, we're going to suspend those for now. So in some ways, I think it's a story of the revenge of shareholder primacy, right? That a little bit later, right, you had Nelson Peltz kind of influencing the board in a rather significant way. And just this last fall, Unilever laid off a third of the workers in Europe, right? Which is sort of a standard move, right? And predictably, it goosed the stock price, right? As you would expect it to do. I'm sure a lot of people made money as a result of that, and probably not us, but we know who did, right? It would have been the activists and those in the know. And I show this because John Fullerton might be known to some of you. John Fullerton, I would say, is pretty strongly on the left, but I just found it kind of an entertaining, response where he says, "Lest anyone think the game has changed in response to all the talk about purpose and ESG, it only takes one putz or Pells of a so-called activist investor, corporate raider is what we used to call them, to destroy a culture and wreak havoc on human lives. For nothing but a short-term pop in the stock price in a company whose business is stable and mature, resilient like a rainforest, lots of systemic health it can provide, but endless growth is a mirage. Pump and dump, just like cutting down a rainforest for a quick buck, and we condone it." Where's Unilever stock today? I don't know if you guys have checked your stock chart. Exactly where it was in 2019 when Pullman stepped down. So, what do we learn from this? What do we take away? And for me, one of the learnings, as I watched all this happen, is that this whole notion of sustainability under the conditions that it has to be practiced, which are, as I've just described, shareholder primacy and short-termism, is almost by definition limited to win-win stuff. We were just talking about this with Andy and others beforehand. Because, in the 80s, the role of government began to be minimized. It wasn't just the Republicans, it was also the Democrats. So government had taken a significant step back. I mean, this is sort of when I was cutting my teeth in the 90s, kind of beginning to try to do sustainable business stuff. And it became very evident very quickly that all of it had to be done, it all had to be market justified, right? There wasn't going to be a policy solution, it had to be market justified. And that meant, at least in my own work, right? I had a previous book called Capitalism at the Crossroads. I developed something called the Sustainable Value Framework, because everything had to be justified in terms of building shareholder value, right? So in this model, there's stuff on the bottom, which like pollution prevention, product stewardship, that can drop to the bottom line pretty quickly because it's about incrementally improving today's business by reducing negative impact or building reputation. Whereas the stuff in the upper part, things like leapfrog, disruptive, next generation clean technology implementation or commercialization, developing business strategies to serve the underserved at the base of the income pyramid, these things are longer term plays to be sure, right? And the simple fact is they just haven't happened, at least not at the pace that we would probably need, right? That if that kind of stuff began a long time ago, we wouldn't be where we are today, In fact, proving the business case, I think, has really limited, it's really code for whatever we do in terms of sustainability can't violate the Friedman doctrine, right, of maximizing profit in the short term. If it does, it's not going to happen, generally speaking. So I wrote a piece, not to toot my own horn here, but I wrote a piece a while back. In fact, Marcel mentioned it in the introduction, called Beyond Greening Strategies for a Sustainable World, and he already gave away the punchline, which was, it won the McKinsey Award. And here's a little clip from that article, and I X'd out the date. You probably have forgotten anyway when he said when it was published. But the distance we've traveled will seem small when in 30 years we look back at whatever the decade was. Beyond greening lies an enormous challenge and an enormous opportunity. The challenge is to develop a sustainable global economy. Greening has been framed in terms of risk reduction, re-engineering, or cost cutting. Rarely is greening linked to strategy or technology development. The achievement of sustainability will mean billions of dollars in products, services, and technologies that barely exist today. This was published in 1997, right? So it's not like we haven't known these things for a long time, right? But I would submit to you that it's been this version of capitalism that we've been practicing for the last 40 years that has really prevented these things from happening in a very significant way. In fact, here's a survey from CEOs just last year at PwC, where a majority of S&P 500 CEOs say their company won't be economically viable within the next 10 years as pressures build from climate disruption, sustainability, and AI. Well, hello. It's not like we haven't seen a lot of these things coming for a long time. Maybe AI is a little more recent. So, is the sustainable movement broken? Or maybe more generally, is shareholder primacy and short-termism a suicide pact? A colleague at Michigan, a guy named Jerry Davis, who's actually written a piece with that title, Is Shareholder Primacy a Suicide Pact? Because at some level, you can see where it leads, right, if we continue down this path. But if that's all true, how do we account for Tesla, right? Like, maybe this was at least for a while the great hope, right? That no, the market isn't just about rewarding short-termism. It bumped along, went public in 2010, at $17 a share, and bumped along for a while, but then boom, look at that, takes off like a tech company. For a while there, like by 2021, its market cap was more than all the other auto companies, right? So maybe that should give us hope. But then, we began to see that Tesla begins to fall to earth a little bit, kind of more competition, shrinking margins, so maybe fundamentals do matter, and you can see what happened to the stock price. It sort of followed the margin. Maybe it starts to look more like Ford, so maybe reality is setting in. And is it a meme stock or is it I don't know. You guys have to be the judge at some level. And if we look at the last couple of years, it's an interesting kind of trajectory because here's Tesla's path, right? Kind of before the election, and the aftermath of the election. It's a digital twin of Trump media, right? If you look at it, follows exactly the same pattern. So, is it fundamentals? Is it meme? Is it both? I don't know, but I'm ready to say that Tesla probably is an outlier when it comes to the discussion that we're having now. It's interesting, it's important, but it's probably an outlier. But then how do we explain a company like Trane Technology? This is a company I've done a bunch of work for over the years. Heard of them? Is that a familiar name? Probably not, right? So Ingersoll Rand you probably heard of. Yeah? That's kind of like a boring industrial company. Well, Ingersoll Rand, again, been around a long time. It was a diversified conglomerate. It was getting slammed. It was beginning to focus. And then in 2019, there was a decision made to demerge the company. There's still an Ingersoll Rand, which has like all the other companies that used to be there. And then Trane Technologies is a focused climate company, right? It's a company that has Trane, right, as a brand, which is heating, ventilation, air conditioning, and climate control, and Thermo King, which is transport refrigeration. So the company is focused on how do we bring cooling and refrigeration to the world in a way that doesn't destroy the Earth's climate, right? That's the mission, to boldly challenge what's possible for a sustainable world. Kind of sounds good, could be greenwash. They've set a gigaton challenge, which is to reduce customers' impact by a gigaton of carbon, looking out to 2030, and they're well on that path. Paul Camuti, who's their chief technology officer, is saying, ESG demands a top-down rethink and design of every aspect of corporate governance and strategy. That's the role of the board. And then if you look at their financial performance, since 2019, It looks like kind of a hockey stick, and then look at the stock. It's been down a little bit now with all this tariff stuff, as you might expect, but that's the trajectory, right? And so you might say, well, hell, this can work after all. The market is behaving the way it should. And in some ways it is, because when you kind of look under the hood and ask, maybe what is it that's really driving this? Maybe it has a little something to do that Trane has won the majority of the business of data center expansion, by the tech companies. And as data centers go from 3 to 10% of the electricity by 2030, that's a huge growth market, and that's driving, at least in part, a lot of their performance. I'm not saying that's a bad thing, except the tech companies and Trane maybe are, we talked about Jevons paradox, in the little meeting ahead of time. Maybe this is just a way to kind of blunt what is otherwise, just an incredible expansion of energy use over the next decade or so. So if the public equity markets, seem to still be, it's tough to defy gravity. What about private equity, right? Because it doesn't have to follow these rules, right? Private equity, by definition, is private. Will the long-term activists in private equity, will some of them ever break through, right? That have this kind of motivation, because there's nothing that prevents them from thinking this way. And I'll just give a few kind of contrasting examples. So here's our friend Nelson Peltz's company, Trian Partners. It's been selling off Unilever shares, including a recent sale of $3.8 million for nearly $232 million. That, I told that story already, and that you can see what the intention was to begin with, versus an Engine One, right? Which people heard of Engine One, little private. I gave away little private equity company that's geared around investing in companies that are powering innovation, driving and real blah blah blah. Right? They were the kind of the small engine that kind of leveraged other investors to get 2 board seats on Exxon. And we'll see what happens. Nothing much just changed as a result, but it's still a pretty interesting achievement, right? For a little private equity firm like that to use their leverage to make something like that happen. But if you look at the assets under management, Trion is $7 billion, Engine number one's $439 million. Or, a private equity firm like LGP, Leonard Green Partners, they've extracted about $645 million from Prospect Medical before announcing a deal to sell it and leave it with $1.3 billion in debt, right? Which is, in the healthcare space, that's been very common, right, for private equity to do that over the last several years. And then you compare that to a company like Compass Diversified that I've gotten to know and sort of become familiar with. Very interesting. At Coty, we're working to set a new standard for responsible investment and management by backing our middle market partners with purpose for the long term. We believe we're building a legacy that's as bold as it is sustainable. Sounds good, right? LPG's $75 billion, Compass is $4 billion, right? So still pretty niche-y. Not a bad thing, but is it ever going to break through? I began to really ask myself that question. Is it possible for long-term sustainable businesses to thrive and become the norm in a short-term and inherently unsustainable system? So, I sort of come to the conclusion that systemic problems require systemic solutions, right? That the problem maybe is this, kind of the larger system in which it's really impossible for individual companies to become sustainable if the system itself mitigates against it. So even in the public equity space, maybe we need to be thinking about the redesign. We need a different objective function, right? There's nothing sacred about quarterly earnings growth. Hasn't always been that way, right? If you look back in time, the market has rewarded different things, not just short-term quarterly earnings growth. Companies have actually seen their stock price rise, like back even in the 50s and 60s, by creating the middle class in this country, right? They actually benefited from that. So there's nothing sacred about the way that it's being done now, but it's going to take probably larger system change for that to happen. So I want to I'll end here with a couple of thoughts about, at least to help think about where are the leverage points for making such broader system change. And I'll use the kind of the metaphor of a tree, right? That in the crown of the tree, you have the leaves and the fruit and the branches. It's very protein, it's growing and changing all the time. And that's sort of like, the issues and problems that exist out there in the world. They're manifestations, right, kind of underlying conditions. whatever they might be. They're constantly new ones popping up. And, right, and if you're a business leader and you want to try to just play in the canopy, then it's kind of like whack-a-mole. You know, you kind of think you got something handled and another one pops up and maybe you get out over your skis and maybe there's rebellion, you know, or a pushback, you know, and we've seen that happen a bunch, right, with CEOs that end up maybe getting out over their skis on issues. So while, you know, the canopy is important and you can form partnerships like Unilever has done, things like Sustainable Palm, you know, or, you know, the Consumer Goods Forum, you know, the Walmart helped to convene. There are certainly good things that can be done around pre-competitive collaboration and partnerships. But probably looking further down, like start with the trunk of the tree where we're talking about the policies, the laws, the tax codes, the subsidies, the regulatory regimes that drive, you know, the issues and problems themselves. This is where Pullman's work, I think, has been particularly important. You know, he and Andrew Winston talk about becoming net positive advocates, right? That we need to align our lobbying with our stated corporate societal purpose, which might just be kind of purpose wash, you know. But if we align lobbying with our corporate purpose and our sustainability goals, that could make a big difference, right? That if we became thing in terms of corporate political responsibility, a colleague at Michigan, a guy named Tom Lyon, has started a new initiative focused on doing just that, right? To align lobbying with stated societal purposes by companies. But ultimately, I think it's the root system is where the real leverage is, you know, kind of the root causes, the first principles, the institutions that define and enable capitalism in the first place. And so Dana Meadows would say, you know, this is where you want to get after if you're going to make system change. It's the goals of the system, and it's the kind of the culture and paradigm of the system is where you can really make an impact. And I come back to, you know, the market, right? Is that's so important, right? Such a crucial place to think about intervening. Is it possible for us to think in terms of creative destruction when it comes to the current public equity markets? So some of you may be familiar with a little startup called the Long-Term Stock Exchange. Eric Ries, you know, the lean startup guy out in Silicon Valley, sort of became disenchanted with all of these startup entrepreneurs, or at least some of them, that he thought were ready to go public, and none of them wanted to go public because the last thing they wanted was for Wall Street to tell them how to run their firm, right? So, I mean, it was pretty clear, right? So he decided that this is a huge problem. We need to start a new public equity market. So he launched the Long-Term Stock Exchange, and it's premised on a different objective function, right? That if you want to be listed on the Long-Term Stock Exchange, you must demonstrate a long-term strategy. You must demonstrate, you know, consideration for all of the various stakeholders and players that are part of that system. And you must, you know, continuously demonstrate an upgrade strategy in order to do that. If you want to be an investor, there's no short-term trading, right? It's a long-term play. So he sort of changed the rules of the game, right, of what the public equity market should be. And I think those kind of things increasingly are going to become important for us to think about. Or some of you might have heard of the shareholder commons. Is that familiar? It was a guy named Rick Alexander, who's a lawyer actually, and was the, you know, sort of the legal mind behind the creation of the benefit corporation corporate form, not B Lab and B Corp, but the benefit corporation corporate form. And as important as that was, he sort of felt that again is just not going to do it because changing individual companies isn't the answer. It has to be a more systemic change. So he's launched this thing called the shareholder commons, which is based on the following logic. And there's some finance professors that have begun to think this way. There's a guy named John Lukomnik at Columbia, who's written a book, you know, called Beyond Modern Portfolio Theory. Some of you might be familiar with it, where he's basically saying modern portfolio theory was premised around, yeah, there's systemic risk, but we can't do anything about it, but we can diversify, you know, idiosyncratic risk. And so that's the basis for investment. But the problem is, you know, 80 or 90 years ago when that first came into play, systemic risk perhaps wasn't the issue that it is now. Now systemic risk swamps idiosyncratic risk, so we'd better figure out how to manage it. And that means thinking both in terms of investors and asset managers, but also individual business leaders. If the actions a given company takes, let's say, you know, are profitable in the short term for that company, but have knock-on effects and externalities that reduce the effectiveness of 5 other companies and lower their profitability and earnings, is that good for shareholder value? Most shareholders own portfolios, right? And so asset managers are universal owners. Shouldn't they be looking to manage that system, right? The overall value of the portfolio, not just the behavior of individual companies? And if that's the case, you have to begin to think about the systemic impacts of what you do. Follow me? There's a whole package of kind of tools that they're developing in the shareholder commons that enable individual business leaders and also asset managers to begin thinking and practicing that way. So that has to do with the goals of the system. When it comes to culture and paradigm, my own view is that business education has a lot of culpability here. Right? So, because since the 80s, I started as a professor at Michigan in 1985, and so I'm a strategy professor, right? So I look back and I can see what happened, right? Which was the takeover of the school by financial economics, which happened during that period of time. And the curriculum became oriented around the graph that I showed at the start, right? That most of the core classes preach shareholder primacy. They're elective courses in the second year, right? I've created programs at Michigan and North Carolina and Cornell and now Vermont that are focused on sustainable business. But until what we did at Vermont, the idea of changing the MBA, we created this new program at Vermont called the Sustainable Innovation MBA, where we threw out the old MBA and started over again, versus just having electives in the second year, but the same core. Right, so I think there's a lot that can be done, needs to be done, must be done when it comes to business education itself, when it comes to the era that we're entering. There's no reason why we as business leaders can't get a hold of this. So just to close, do we need a new operating system for capitalism? The more and more, you see more and more books being written around that theme, and I just have this one quote from Peter Georgescu, who's the ad guy, right, Young and Rubicon, where he says, "For the past 4 decades, capitalism has been slowly committing suicide. Deliver earnings, push up stock price, or perish. Simply put, shareholder primacy has become the kind of cancer that needs to be eradicated before it destroys our way of life." Pretty strong words for an ad guy, One close, kind of a benediction. I'm not Catholic, but I think this is a story about Pope Francis. It's in Mark Carney's book, by the way, the soon-to-be Prime Minister of Canada. Which is a great read. It's super thick, but it's a great read. And it's a story that he tells about a dinner at the Vatican that he attended that the Pope hosted. And the Pope offered some remarks, at the beginning of the dinner, and they were as follows. "Our meal will be accompanied by wine. Now, wine is many things. It has bouquet, color, and richness of taste that all complement the food. It has alcohol that can enliven the mind. Wine enriches our senses. At the end of the feast, we'll have grappa. Grappa is one thing, alcohol. Grappa is wine distilled. Humanity is many things, passionate, curious, rational, altruistic, creative, self-interested. But the market is one thing, self-interested. The market is humanity distilled. Your job is to turn grappa back into wine, to turn the market back into humanity." I think that's it, that for the last 30 years, 40 years plus, the market has become the master, and the market needs to become the servant once again, which it was originally tended to be. I will stop there. Thank you.
So thank you, Stuart.
Yep.
Very thought-provoking statements. And I'm sure now we have a very interesting panel discussion, and I will be very brief. The audience can ask questions at the end of the panel discussion. We have a QR code up here where you can then get there and submit your questions or so. The panelists, other than Stu, is Tony Elliott. He's the chairperson of the board and former CEO of Silicon Holding Corporation. And he's a, I think, believer in shareholder primacy, but with a long-term view. So it'll be very interesting to see how that connects. Then we have Anelia Crawford. She is the head of ESG advisory at UBS. She has a background in representing activist investors and now has changed to the bank and basically helps the bank to the mergers and acquisitions group to basically do activist defense. So she has also a lot of exposure to these questions, and she will provide her point of view from the point of view of an investment bank. And then finally, we have Andy King, Alan and Kelly